Hi, my name is Kunal, and welcome to the Geeks of the Valley podcast, which connects with some of the brightest minds globally who are leading their respective industries today to discuss the hottest upcoming industry trends and how their work is affecting the global economy. This morning from the San Francisco Bay Area, we have a very special guest joining us, the founder and managing partner of Strive Capital, Nuno Goncalves Pedro. Nuno, thank you so much for joining us this morning.
Thank you for having me, Kunal.
Very excited to have you.
Excited to be here.
So let's jump into the first question. Tell me about yourself and your background and how it led to you to the path of VC.
So I have a long winding background. I'll try and summarize it as well as I can, although I do always fail to do the elevator pitch on my own background. I've been in tech now for 24 years, actually, as of the end of this month. And I've had three very different stages of my career. Originally an engineer, I have a master's in science and computer engineering. And I started by developing systems, some of them, shockingly enough, still in production today, still being used today all around the world. I then became an engineering manager. I wasn't a 10x developer, and very early on, I believe the competitive side of me told me, you need to be the best at, or one of the best at what you do, and this is not that thing. So became an engineering manager, and over time a product manager. I jokingly say I always should have stayed as a product manager, and had I been a product manager in Silicon Valley rather than at that time in Portugal, where I'm originally from, I probably would still be a product manager today. So that's the first cycle of my career, really the direct tech development, product development part of my career. The second cycle was really where I sold a little bit to the dark side and became a growth operator, a manager, and basically took responsibilities for different areas of growth. On the organic side, really product strategy, product planning, product management. And then in your inorganic side, really around business development, so strategic partnerships, alliances, high-touch sales, and corporate development, M&A, and investment. Finally, I also always had a component to my work, which was really very strategic. So I did a lot of strategy work, business operations, and a few other things. Had a few scale-up situations in my career during that stage. Some really significant ones from, one that comes to mind is taking an organization from 25 people to 1,000, 5 million in income to 200 something million in income, mostly actually through inorganic growth. And so very proud of that part of my career. I then took a little bit of a turn that I still put a little bit inside my operator part of the career, where I joined McKinsey & Company in Asia Pacific, and I was a senior expert and member of the leadership team there for 6 years. And there, the work I did was always around the same topics, so product, corporate development, business development. So think of me a little bit as a guinea pig, or one of the guinea pigs at that moment in time, for what has now become the new McKinsey, a McKinsey that does offerings that go well beyond management consulting with McKinsey Digital Labs, McKinsey Solutions, and a few other areas that they've launched since then. I was based in Beijing, so my shifts are always significant. I shift continent when I shift my career, and had actually an amazing time at the firm, and very proud of the work we did back then, and certainly of McKinsey as an organization. Around that time, I started really getting intrigued by startups, intrigued by companies that scaled really, really rapidly. I'd helped one company when I was coming out of GSM Association, and actually helped them even exit to a NASDAQ quoted company. And the bug was already there. So I was really, stuck with that bug in my head. And so started spending time 2007 in Silicon Valley, in the Bay Area. At that time, San Francisco wasn't really a center like it is today. It was really more Silicon Valley, or classic Silicon Valley, Palo Alto, Mountain View, Sunnyvale, etc. And took a few advisory board positions that really led me to understand the startup cycle a little bit better. And then there was a really significant eureka moment in my career, which is the launch of the App Store by Apple in 2008. And the view that there was going to be a mobile app economy. And having worked a lot around mobile, I decided it was time for me to put money where my mouth was, and be beyond a consultant. and started at that point in time Strive Capital, which I'm still managing today, on the verge of our third vehicle, having really worked very extensively in our first and second vehicles with investments like App Annie, Gusto, Rubrik, Verta Health, DraftKings, and a few others that people might know of. More recently, I've also taken a venture partner role in the last 2 years with Grisham Robotics, which is more of a physical tech, frontier tech investor. And I've really stepped between those two worlds, the consumer software as a service space, where I really focus most of my activity at Strive on, and then the Grisham Robotics world. This is a Sandhill Road fund that focuses a little bit more on the physical tech space. I would say if I have any skew as a venture capitalist, it's really towards consumer or consumer-like software as a service. So I like the dynamics of consumer. A lot of investors avoid consumer because it's very difficult. It's difficult to predict what's going to be big or not. That's really the space where I thrive. And addressing the end of your question on the path to VC, in some ways, VC brings everything together. It brings my engineering background together, my product management background together, my growth operator background into play. And using a term that Amazon, for example, uses, a little bit the notion that venture capitalists that probably do the best are some sort of athletes. They are broad at the top, general managers, as we used to call them, but they actually have one or two spikes where they're really, really, really good at. And that's been, I think, the case with me, hopefully, with a little bit of eating a little bit of a humble pie, but very spiked on corporate and business development and product, and at the same time someone who's had this overlay around general management, strategy, and a few other areas that lead me to understand new industries very, very rapidly, to make a distinction around what works and what doesn't work in an industry pretty quickly, but also over time really understanding people, which is one of the big dimensions of being an investor, understanding how people behave, what leads to grit, what leads to incredible entrepreneurs versus people that actually give up at the first sign of issues. So a long-winded answer again. I can't quite nail my elevator pitch yet, but basically that's my arc.
Nuno, it was a fantastic pitch. Now, I know you'd mentioned earlier in the conversation, you were talking about one of your most recent projects, right? Which is being the managing partner of Strive Capital. So what is the fund investment thesis and what type of check sizes do you write?
And I'll start with the foolish part. A lot of people think that all venture capitalists are incredibly well in life and we're all amazing and we get paid a lot of money with management fees and we have amazing salaries and we have this, it's a profession that in some ways it's incredibly misunderstood and glorified for the wrong things. I love being a venture capitalist, but I'm actually an entrepreneur in venture capital and started Strive Capital from scratch with a co-founder. The first stuff we did was around 2010 and then more formally moved into the Bay Area in 2012. Strive Capital, the objective of Strive Capital, the first fund, was really to participate in the mobile app economy. And very early on, we realized that the only way to de-risk, in particular, investments in consumer is to see if there's ways to cheat your assessment of the company. And so the way we started cheating in some ways, and I'm using obviously a very strong word, is we started to be very analytical about the evaluation of deals. And we'll come back to that probably later, but that was a little bit what was the genesis of Strive Capital. Very early stage, we were doing Series Seed when Series Seed still didn't have properly a name. So we were thinking about rounds between 1 million to 1.5 million. Obviously, Series Seed has changed quite a bit in the last 8 years in terms of size. We were very focused on the consumer space and early on what we believed was a big trend. Again, I think we were a little bit ahead of our time, maybe a little bit too much ahead of our time in some cases, which was consumerized enterprise, what some people now call bottom-up software as a service and other services. And we were writing small checks. We were a micro venture capital firm. We were writing $500K to $1 million checks. Strive has evolved. The second vehicle, again, writing a variety of checks around the space, again, mostly focused on Series Seed. And then the third vehicle that we're now working on is going to focus on the new Series Seed, which is now $3 to $5 million rounds. And so we will effectively step into that with more capital per deal, but some of the similar dynamics that have happened over time. So Strive Capital has evolved through time. It has really maintained this logic of We are here to obviously support entrepreneurs, to choose the best entrepreneurs, but we're also here to be a great fund manager and really have the core skills of a great fund manager.
So, from my understanding as well, you guys have a very different type of model, right? You're one of the first quant-focused micro VC funds. So, what types of analytics are you using to derive early-stage investments, other than just betting on the team and the product prototype, like most early-stage and micro VCs bet on?
And to demystify a little bit the quant VC side, it's not like, me and my partner when we first started this, and then I stayed with the firm and he moved on to go back to being an entrepreneur. It's not that, we initially said we're going to have this grand aim of being quant. As I mentioned before, it was just investing in consumer. We needed to significantly de-risk product market fit. That's the single most difficult part of investing in consumer, which is to anticipate whether there will be consumer product market fit or not. So that's where we started from. We started from the notion of, if we have data on companies early on around traction and sentiment, and over time we started focusing a lot more on retention and engagement metrics, we would highly de-risk those deals. And we started realizing, actually, not only would that help us in doing due diligence on companies we were looking at, so what we would call the mid-funnel piece close to deal making, but actually that would help us as well with a top of funnel piece in deal sourcing. We could identify companies that we would have otherwise missed by looking at data in a relatively unbiased manner. And I think that's what the analytics driven piece brings to the table. It brings a de-risking of certain aspects of analyzing a company which we think are fundamental, but it also brings sort of the debiasing of the whole process. We in VCs have our own networks. You're either a Stanford alum or a Berkeley alum or an IST alum in Portugal, and so we have these networks of influence and access. And so your sample of deal flow normally is not random. And what we believe was that the analytics engines would help us with both of those things. What we've realized over time is actually we can really amp up the analytics. Again, very focused on deal sourcing and due diligence. And we really can create feedback loops into our whole process of decision making as we move forward down the funnel. Into Fund 3, as we're going now, there is really a thesis and an architecture that we believe is incredibly differentiated from the rest of the market. And if you think about it, and not to be too professorial, there's been a lot of focus by VC firms in what I would call the classic playbook that probably originated post 2001, 2002 after that crisis, which was really around creating brands and creating playbooks around networks of influence. I'd say Andreessen Horowitz was probably, as a firm, the most aggressive one, really around 2009, 2010, coming out with very aggressive PR. I would say Mark Suster at Upfront, again, someone who played that playbook exceptionally well with both sides of the table. That playbook, I think, is a little bit tired, so it doesn't work as well going forward. And what we've seen is, again, in some ways, Andreessen Horowitz being, again, one of the innovators in that space, moving to post-investment and really, while having a lot of assets under management, bringing a lot of shared services to the table, from market development to marketing to PR to their portfolio companies. We believe that's all great, and you can play those playbooks, and particularly if you have a lot of assets under management. But if you have less assets under management, you need to actually innovate in other parts of the puzzle. And actually, if you think about it quite quickly, you would say that the picking piece of venture capital is where most of the value is created. So the deal sourcing up to deal making is normally where value creates. And my thesis is, you can't, as a venture capital firm, magically turn a company that would have been a 1x, 2x otherwise into a 100x just because of the value that you bring post-investment. So upfront, you really need to focus a lot on the picking part. And I think Benchmark has edified that very strongly, a firm that has been very historically focused on picking. So that's what we're trying to do. We're trying to innovate around the picking stage. We're trying to really de-risk everything. And we're playing every other game that every other fund is doing as well, creating brand, networks of influence, but we're adding the layer. We're augmenting ourselves with analytics engines while putting the human part, strongly in the loop. So this is not a system that makes decisions for us. It's a system that augments us and helps us make decisions. But in the end, there's always a human involved. and Kunal, I think, there are elements of the evaluation and due diligence of in early stage. This is early stage. I mean, early stage is very difficult, right? You have to take into account the teams. You have to take into account, the CEO, the founding team, and do a lot of evaluation that